Hi, and welcome to a special weekend edition, a very concise three-market view on Sunday, May 1st, 2016. This is to recap what we thought were the several markets that were most important to the broader trends in all of the other asset classes, and a particular insight on the foreign exchange that could not wait until Monday morning. And of course, the reason for that is that the influence of the stronger sister U.S. on the rest of the equities is very important, as we head out of the end of the disappointing activity last week. Pardon me. And the U.S. dollar index has broken some key support, yet that was without the dollar versus the euro, or I should say the euro versus the dollar, pushing up to any sort of new high. And that's very interesting as well, and that was based on the weakness of the yen. Now, all of the previous background still stands, so we refer you back to the full video from Friday morning, and below the video in that post are the market observations that covered all of the various asset classes, including the technical discussion for the video we're about to produce here. But what you need to know is the degree to which the central bank accommodations, failure to encourage higher equities over the last couple of weeks, ECB a week ago Thursday, and this past week the Fed, and in spite of some disappointment, the still accommodative BOJ is starting to bring home the theme that the central bank's influence is waning and will be back to trading off of data. So we have to ask, what has all this meant to the markets? Well, as you can see, is our usual hourly chart on the left, 30-minute on the right for the S&P 500 June future. What we have is a situation where the attempt to hold in against the key 2075 to 2085 area and push out above it from the week before last failed, even in spite of the ECB accommodation. This market was on the way down into that Thursday already and ended up under further pressure, even though the ECB made clear it was going to remain accommodative and do more if necessary. Now, after Monday's dip down to the 2071.5 area, just a bit of leakage below 2075, this market tried to rally, and here you go into the Fed on the 27th, where after a little bit of nervousness it tried to push up, but none of these subsequent rallies, after testing in front of the ECB going back to a week ago Wednesday, the 2103 to 10 resistance we'll revisit in the intermediate term charts, none of them got back up even to 2100. The best you did above 2075 to 85 was not quite $10 above it before you stalled again. And then after a still accommodative FOMC on Wednesday, you got that lack of further quantitative easing or further move into NIRP, NIRP, the negative interest rate policy by the Bank of Japan Friday morning. Much like the ECB, they'd taken a lot of heat for how that affects the banks, and they stood pat. And in spite of that, maybe the accommodative Fed meant the market tried to rally on Thursday, but by late in the day, after lunch, it was back under pressure. And most importantly, it left a fresh down break from the 2077 area. And it left a down break just below that out of a very well-formed head and shoulders tops, going all the way back, interestingly enough, from when it evolved from after it gapped higher back on Wednesday the 13th. And left the left shoulder, head, and then the right shoulder into the Fed and the BOJ, so it's broken down out of that as well. Now that down break, let's call it 2076, after a high up here at 2105, that's approximately $30. That points toward an objective right around 2034. Of course, that's right back into the lower support down at 2035 to 32. But more importantly, The next support below 2078, basically 2075 to 85, so let's call it below 2075, was in the 2060 classically, with a tolerance from that gap higher on Wednesday the 13th back to the close on that Tuesday of 2055.70. And we said if that gets overrun, if they close off that gap and start trading below it, it's a problem. Even though they squoze back up late in the day on Friday, that's a problem. Because two things happened there. As we suspected, both the 30-minute, but especially the hourly MACDs dropped out below their lower runaway bands. Even though the 30-minute is back up at the band, this being below it leaves room for a rally that could fail. And the fact that you're below 2075 to 85, and especially that major weekly channel up break we'll see momentarily, is a failure of an up break at the top of a very big rally. A very big up break failing at the top of a rally, as we said, that's typically not good. It leaves this now set up as key resistance, 2075 to 85, and unless the market can get back above that to fully negate these down breaks and claw its way convincingly back up into the upper band again, it could be in trouble for that swing down at least to 2035 to 32, and the lower bigger support is back down around 2015, the 2020 to 2010 range. We shall see. And that pretty much does it for the short-term view of the S&P 500.